How hard is that? It's like, I'm thinking of those poor astronauts that are still stuck up in space because Boeing can't figure out how to properly build an aircraft or whatever the hell they did wrong. I mean, it's just unbelievable. Not to mention the planes are all crashing also. Anyway, so here's the poor NASDAQ. Not pretty at all. Let's see if we can get a better picture. What was I thinking of? FinViz, right, there you go. No, stock charts is better. Okay, so we'll do a gallery view. And we'll do the star dollar NDX. Oh, so here it was going happily along, and then it fell off a cliff. This isn't because Tesla and Google slipped a little bit. This is a massive, one-day pull down. That's why I like the gallery view, because you get 3 different charts. You get the intraday and you get the daily and the weekly. And that way you don't have to switch back and forth. You can really just sort of drill down and look at all this stuff. As I was saying, I believe it was yesterday, that you can't fight these. In fact, yeah, there you go. The best place to find out information is on my own site, in my own posts. Oh, and it wouldn't be in a top trade alert. Silly me. It would be my Tuesday article. I'm pretty sure I talked about this Tuesday. Look for NASDAQ charts. Oh, I'm sorry, it's an S&P chart. All right, so same thing. Anyway, so believe me, the S&P, the NASDAQ chart looks the same. The RSI, when you see the RSI, the relative strength indicator over 70, it's overbought. This line is here for a reason, and that line's there for a reason, and this is overbought and this is oversold. And on a broad market index, those conditions are not likely to last that long. And we talked about this, I think, last week. I'm pretty sure we did. It's so, for me, it's so tedious to listen to my own webinars. I don't go back and look to see what I've said. It's like I said it, I kind of remember it, and that's that. Just because it's me talking. It's like I don't want to hear me talking. So anyway, look, trust me, without getting heavily into it, trust me, 70 is way overbought on the RSI. So when you see that for a broad index, you got to take it seriously. You have to imagine that there's not going to be a lot of buying power left to support things, and anything that can go wrong. Look at that. And there's exactly my main point, was this. Also at issue is the companies that have reported positive earnings for Q2 have seen an average increase of just 0.3% versus a 5-year average of 1. So in other words, they're going up 1/3 as much as they usually do on positive earnings. And companies that have reported negative earnings have fallen 1.7%. So 1.7% is more than 5 times a fall compared to a rise on earnings. So even if you have 4 beats, the 1 miss will wipe them all out. So the beats have to be less than 20% misses for this to continue. And at the moment, we were coasting along at 80% beats, but you need that in order to justify this kind of stress on the RSI. And you can't. It's not going to last all of earnings season. Who reported at the beginning? A bunch of big banks, and the big banks, they manipulate their own earnings. They can take profits and losses in 100 different ways to make their earnings work. Some of the big tech came in, and what else came in? Some of the big some consumer cyclical came in, and in fact, we have a breakdown on that too somewhere. FactSet is really good for these things. Let me see. Here you go. Very nice. So I don't know how well you can see that, but here's consumer services. That's been going well. Healthcare, infotech, and of course this is with a very small, only 14% of the S&P has reported, so 80 companies have reported out of 500. But consumer services have gone well, healthcare has gone well, infotech has gone well, financials have gone very well. And there's the average for the S&P 500. So you're averaging almost a 10% beat. Well, not 10, so not 10% beat, 10% earnings growth. But you know what's funny? 10% earnings growth doesn't justify, oh, where'd that thing go? Well, it does justify it if you can't find it. What the hell? Was it that? Oh yeah, we were talking about NASDAQ versus the S&P. Well, let's go to the S&P then. That's easier. It's easier than constantly saying, let's remember what the S&P is. So S&P just is sad. Actually sadder because look, we're coming to the 50-day moving average already. That's nasty. So what was I going to say? Yeah. So going back to last July, the S&P was at 4,400. And now now I pull back, but now it's at 5,500. So it went up 1,100 out of 4,400 is what? It's 1/4, right? It went up 25%. So if the S&P is up 25% in a year, but earnings are only up 10%, what does that mean? It's pretty simple. It means you're paying more for the same earnings. You're paying more money per earnings dollar than you would have. So earnings went up 10%, but the S&P went up 25%. So you're paying 2.5 times what the earnings growth really was. That's nasty. That gets exponentially nasty in the PEs and so on and so forth. So the only way that's really sustainable, even if we thought that this was fair, even if we thought that this was deserved, the only way it's sustainable is that you've got to continue to see very strong, surprising earnings numbers, and 10% is not that. So it's not just beat, but beat by how much? And also, we know that this S&P number, 40% of the earnings growth or more, actually, I'm sorry, more like 60%, more like 60% of the earnings growth is coming from the freaking Magnificent Seven stocks. So when the other 493 stocks report, they're not going to be as exciting. So, sure, we've gotten a good amount of good earnings reports with some of the big reporting stocks, because frankly, you could say it's not rigged, but the reality is when you set an earnings date, who's going to report first? Especially when you start doing earnings on, what is this, July? Like July 17th was last week. So in the middle of July, you start doing earnings through June 30th. So who is going to get their earnings together in 2 weeks? Only very large companies are going to get their earnings done and certified and organized and have presentations ready and blah, blah, blah. You need to be a really, really big company to do that. Other people are busy. And I don't mean like small neighborhood companies. I'm talking about like a company with thousands of people. If they don't have layers and layers and layers of management, and the CEO, is so remote from the company that all he has to do is go on TV and talk, and he never actually has to go to the factory floor and deal with the problem. Those are the kind of companies that are going to be reporting early on in the cycle. Everybody else is going to say, because they ask, when are you ready to report? It's not alphabetical or anything. They're like, when are you guys ready to report? So Goldman Sachs is like, ready, I'm born ready. I'm ready to report the day, on the day the thing closes. So they do. That's who goes first, the big banks. They're the first major S&P companies to report are the big banks. And there's, the few strays that have weird years and things like that. But I'm talking about like the regular guys who close their books on June 30th for Q2. Who the hell's ready on 2 weeks later to give their earnings reports? Only really big companies that are totally on top of their shit. So those are the companies that are going to give you good earnings. The guys who are swamped and are dealing with problems on a regular basis and are trying to make their business grow and have to struggle in their quarters, those guys aren't ready to give you earnings in 2 weeks. So the natural progression, if you want to call it natural, it's an interesting thing because it's like it's fixed so that it comes out a certain way because the rules of the game dictate that this is how it'll work, which is what the Wall Street wants it to be like. They want their stars to report first to kick earnings season off in a positive light. The game is designed so for that to happen, and that is what happens. So the big organized on the ball companies are the ones you hear from first, and then you hear from other guys. But then when you start hearing shit like UPS was really a big rock in the foundation yesterday, they reported some sketchy earnings, and UPS is a linchpin for everything else. Even Amazon, even your online companies, they still haven't figured out how to get around delivering a package from one place to another. So if UPS isn't actually running around delivering, what's going on? Who's buying stuff? The malls aren't selling stuff. UPS isn't selling stuff, isn't moving stuff. So what's going on? There must be a pretty big hole somewhere in the direct to consumer spaces. B2C, as they say, right? So and B2B. I mean, UPS does both. UPS is running backstage for both. FedEx's numbers weren't fantastic either last time we looked. They pretty much wiped out their competition. Yellow Roadways, a lot of the truckers, they're all dead. COVID killed off the competition. There's really UPS and FedEx. Even DHL is like, where the hell are they now? So that's a pretty bad indicator. And then today we hear from Google. Now, if Google's not making money, and they are making money, they're making boatloads of money, but not phenomenal jumps like everyone expected. And Google. Oh, how far? What are they doing? Yeah, they ended up down 4.5%. So they hit the 5% mark. So Google from last year was, call it 120, and now they're 175, they're 180. So they're up 50%. Are the earnings up 50%? No, they're not. It's just more expensive to buy a stock this year than it was last year. Paying more money for the same earnings. If that's the case, then you've got to be shown something better than that. That's what our watch list is for. That's why we started doing the watch list. And we're looking for companies that are serious values. That are really, that are not these runaway companies, not these ones that have gone up so much. We want the value companies. Nonetheless, things are not perfect. So let's see. So we talked about the earnings. We talked about S&P earnings growth year over year, blah, blah, blah. So earnings are up, but only for Amazon, Google, Meta, and NVIDIA. They're up 56%. But don't forget, that's mostly NVIDIA. NVIDIA went from 0 to 1,000. So NVIDIA is really taking all this up, and it'd be nice if they broke that down to be more useful, but they don't. But then talk about not breaking down though. Then the other 496 companies in this case in the S&P 500 have only grown 5.7% in earnings. Yet the index is up 25%. Don't buy the index. Don't even buy these guys though, because they're already pricing it in. Everything is priced in already. So we looked at the different sectors. We have the big banks had good earnings. The tech sector was mixed so far. Netflix, TSM, consumer goods, Coca-Cola. Pepsi was disappointing. Coca-Cola came in good. Procter & Gamble came in good. United Health comes in good. United Health, but when United Health does well, that's not necessarily a good thing because they are the primary healthcare provider in the United States. And so if they're doing good, that means that they are skimming more money from, they're taking more money from the people, the customers, the working people. They're giving less money to the actual doctors, and they are creating a gross inefficiency in the system. They keep about 1/3 of the money, 1/3 of what's spent on a healthcare outcome, they keep. So they take in 50% more, right? It would be 2/3 for the person paying. So they're taking 50% more money and keeping it. Don't give it to the doctors. Don't give it to the hospitals. It doesn't go to buy equipment. It goes to United Healthcare, who keep the money and have a profit and pay their own administrators and so on and so forth. They have to pay all these people to deny your claims. They have to pay all the lawyers to fight you when you try to collect the money. You're paying for that. You pay them in advance so that they can then get lawyers and get psychologists and all sorts of people to figure out how many possible ways they can deny you claims and get rid of you without paying you what you should be paid when you get sick. That's what United Healthcare does. That's what the company's purpose is, to not pay you. Their purpose is, as a company, is to take your money and not give you the least possible medical care that they can. No matter what happens to you, it doesn't matter. You are the generic customer, and their job is to not pay you anything. Ideally, they want to take all your money and pay nothing back. That would be their ultimate goal. Pay nothing to any doctors and nothing. They would love to get all healthy people, take all their money, and then never pay it out. But they don't. They get stuck with some sick people. So therefore, they have a million rules and hoops and stuff to make them jump through. That is the purpose of United Healthcare. They don't have another purpose. They're not there to help you get health care. If they were there to help you get health care, they'd say, go to any doctor you want. Maybe they could say, go to any certified doctor you want. That might be better. But say go to any, if they were really trying to help you, they'd be like, okay, you paid for it. Go to any doctor you want. We'll write him a check when he gives a bill. That's what we said we would do. We are healthcare. We're supposed to take care of your health. But instead, they're like, here's a list of our approved doctors, blah blah blah. And if this doctor tells you to go to another doctor but doesn't fill out the proper paperwork, we have the right to deny your claim because he wasn't referred properly, or if he's out of network. So your doctor has to worry about whether or not the person they're referring it to is in network and blah, blah, blah. And then that doctor, if he bills you, can only bill you within a certain guideline. If he bills you over, it's your problem until you sue us, and then maybe we'll take responsibility. It's a horror show. It's a completely unnecessary thing that we pay for in just staggering amounts of money that get paid, not just United Health, but all these people. It is a sick thing. U.S. healthcare is the worst in the world. The system is just set up to drain money out of the consumers. And see, the doctors used to be really happy about it because they got richer and richer and richer. But what happened is now the healthcare companies have tapped out all the people, can't afford anymore. And so instead, they are going after the doctors and just paying them less and less and less, and they're ruining it on that end also. And so we end up having worse outcomes and so on and so forth. Have you guys seen this? This is crazy. Life expectancy chart, US versus world. Is it? Well, I mean, look, in part, this is because of COVID, but look what's happened to us. Our life expectancy went from 75 years to or whatever this is, 77.5 down to like 76.5 or something like that. There's better charts than this. Oh, yeah, here you go. Although we had this super sharp drop off because we ignored COVID. That was the main reason, right? We had a big sharp drop off, but we didn't recover well, not at all. Our outcomes are horrendous compared to the entire rest of the world who live to be 82 years old. But if you're an American, you live to be 76 years old. That's like 10% less. You get 10% less life for 200% more money. We spend 200% more on healthcare than the rest of the world's average, yet we live 10% less. That's a really messed up system. But who's going to fix it? certainly not the people running. Oh, there's another one. Oh, Jesus Christ. Yeah, I mean, you just any over and over again, you're going to see this. G7's life expectancy. Oh no, I hope that's not us. That is us. Wow. It's so sad. See, it's not just COVID, it's a total trend. Rankings, life expectancy rankings, US 53. 53. We're not number 1, we're not number 10, we're not number 20, we're 50 frickin' 3. It is horrible. The whole situation is a disaster. And it's just getting worse and worse and worse. And they want to dismantle Obamacare and take away those gains. Ooh, that's fun. How much longer do we have to live? Let's see. Women continue. All right, let's see. So, how much longer do you have left to live? What does that mean? Okay, so if you're okay, I get it. I'm just trying to figure out these lines. Oh, I see. You gotta look back. All right, so if your current age, so your current age is 65, which means you're here. I get it. Okay, so I'm here. And that means I, as a boy, have a pretty good expectancy and get to 80. That's all right. That's not terrible. If you're 65, you only get a little couple more years. If you're 70, you're moving on up. I know what +2 means. Oh, that's for women, it's +2. If you're, as you get older, my mom is 84. Yeah, my mom's 84. So they're giving her probably, it looks like 90. But anyway, so I guess it's interesting trying to figure out how many years you have left. So what do we say, 80? 20 more years? I don't know. I hope we can do better than that. I'm hoping for some advances. Let's see. And you know what it is for me? It's like I just always want to see. I always want to see what comes next. So it's like it's the main reason I don't want to die is because I'm too curious about like what the future is going to be like. I want to see it. So don't take that away from me. That's my fun. Anyway, all right, well, forget it. So healthcare bad. Let's put it that way. Industrials, very, very mixed. We know industrials, that's going to be, so when industrials start reporting, that's going to be bad. Energy, I always just want to me, it's like, it's pretty easy to predict energy because all you got to do is look at the freaking future, the market. Can we go daily? Is that maybe enough time? Yeah. So oil into early June was falling and falling and falling. I'll go to the dailies. So, you got to think of your quarter, right? So you had January, February, March. So starting here, what happened to oil? Oh no, it was down, went down and down and down. But the question is, how far down did it go compared to how much it went up in the first quarter? So in the first quarter, it started at 72 and went to 82. And in the second quarter, it started at 82 and it came down to 77, probably actually averaged a little bit more in the second quarter than the first quarter. And we stopped here, don't forget, so this doesn't count anything below here. So your average is pretty much 80 here, and the average is certainly less than 80 in the first quarter because here's 80. So you can see the big gap in there. And that's how you figure out how our earnings are going to be. Then you look at gasoline and see how gasoline was. And in gasoline, say gasoline was in the first quarter until March 31st. It was going up and up, but it kind of probably is in the middle here at 240. But in the second quarter, you're starting in March, and it probably averaged 255-ish. So the cost of gasoline was higher. The cost of oil was higher also. So that means that a refiner won't do as well because the refining margin, well, it depends how far ahead. You have to do the actual math. But the refining, if the cost of gasoline didn't go up that much, then and the price of oil went up, then it's not good for the refiners, but it's good for somebody like Exxon who does both, but not for Valero. Valero doesn't do any exploration. So that means a big company like Exxon or BP or Mobil. No, I said Exxon or Chevron. The one, yeah, Chevron. People like that who do exploration and refining, exploration, drilling, and refining, they're going to do better. But then you have to say, well, what else do they have? The Exxon's got a chemical corporation. Exxon does natural gas. So now you got to look at natural gas and see how that did. And natural gas, January, February, March was pretty much a disaster going all the way out. But then is it any better for the next quarter? It's probably about the same, right? This down slope kind of matches that up slope. Oh, I'm sorry, we get into July. No, I'm wrong. So this is probably better. It seems to be a bit more up here on this side than there was over here, because here you catch February and March are both pretty crappy months, but here really only April is terrible, and then it starts getting much better for the gas guys. So who's heavy into gas? Chevron happens to be heavy into gas. So Chevron is probably going to do better than Exxon. So this is how we start building a picture of earnings season. You got to pay attention to who did earn and what's been going on, and then we try to extrapolate what's going on in the future. Extrapolating, that's exactly what it is. You gotta figure out, based on what you've seen before, what's going to happen next. But you also have to be careful, as this cartoon illustrates, not to be ridiculous about it. Things don't just always continue for no reason. You can have a bump, but then you hit a wall. All right. So I asked Bodie yesterday to say who's going to beat and who's going to miss, and he said Google would beat. They did beat on earnings, but not by enough. Microsoft, he thinks, is going to beat. Tesla, he said, despite the recent price cuts, increased production capacity and growing demand in key markets like China. Growing demand in key markets like China could lead to better than expected results. That's not quite what happened. Did not go as well as expected. So Tesla's down, what, like 10% right now. He says Intel will still be challenged. That's sad for me. American Airlines, we already know, is got some serious problems. American Airlines just went through five days of outages, of not all outages, but from that CrowdStrike thing. They're still having problems getting back together for whatever reason. Their system, I think to some extent that like if your system goes down, they may have chosen to do a reboot, trying to get back up and running before the situation was fully assessed, which, these days it's very paranoid with cybersecurity threats. So they might have thought that was the prudent thing to do, was to just get off, like break from the system, do a reboot, lose a couple of days information. But if you're an airline, you lose a couple of days information, that's people's bookings. You can't do that. So there's repercussions to anything they do. Any choice they made would have caused other problems. But think about it. You come into the office and you see that like blue screen of death. and you try rebooting the computer and that doesn't work, and you don't know what's actually wrong. Then you hear that your security software, CrowdStrike, is causing the problem, and now you're like, holy shit. So, probably as fast as possible, you're going to disconnect your computers from the internet and try to figure out what's happening. But these things are so complicated now that, like, you can't expect your in-house programmers to even know what's going on. It's dangerous. It's very dangerous. People don't even know how AI works. The people, I mean the people who work with AI don't know how the AI works. They build these language models. They evolve them to the point where they start feeding on themselves and learning and giving better and better responses and so on and so forth. But they didn't really program them that way. They allow them to evolve into what they are. But that's not the same. So there's no real people that can say this or that will change this and this and that is going to change that. There's no one who understands the whole of the coding of AIs. And just like Windows, so Windows is so complex now that there's no single person who knows how Windows works. Like Bill Gates wrote Windows. The original Windows, Bill Gates wrote it. He knew every single thing. If you wanted to add or subtract something from Windows, he knew where it was and what to do. Now you need a whole committee to have a meeting to figure out, what design elements things are going to affect. Systems have gotten more and more and more complicated, just like your car. I don't know about you guys, but when I was a kid, I mean, this is going back 40 years ago in college, but 40 years ago in college, if there was something wrong with my car, I would take out my wrench and my screwdriver and my hammer, and those were the only tools I needed to fix my car. It's fine. I would find the problem. I would move pieces. I would take pieces of the engine out and put them back in and look at the parts and pull on the belts and look for leaks and so on and so forth, because it was a pretty obvious machine. It was like, I could fix that. I took, when I was a kid, I took my mom's vacuum cleaner apart and fixed it. It's like, well, this belt connects to this belt and there's a key here and a thing here. And it's, if you put them all back in the right place, it's going to work again. You just got to look for the thing that's what's wrong inside it. So that used to be the case. Now, if I open up the hood of a car, there's like they actually purposely block it so they don't want you to touch it. There's a whole they block out pieces. You could remove it, but I don't want to touch it anymore. But now it's like connected to a computer and it's a solid block of steel and you don't know what the hell's going on inside it. And there's nothing to touch and there's not a place where, there's no, fluids go on the side and magically get to the engine somehow. It's like, I wouldn't want to touch one of these things. They've gotten way too complex. Still inside, so, most of them it's still basically the same kind of internal combustion engine following the same principles that my college cars had, but it is not the same at all. So we will see how that goes. Anyway, what day is this? This is Tuesday. This is yesterday. Oh, and we do want to get to, where was it? Did I leave that open somewhere? Nope. That's the June portfolio review. Ooh, how are the portfolios doing? Where are we? This is the short-term portfolio. Whoa, you see it just jumped from 80 to 121? That's crazy. So obviously haven't touched it. But yeah, so we're up. Well, how badly is the NASDAQ down? Like, this must be pretty bad if we're up 121%. Oh well. I don't know where it is exactly, but anyway, so we bumped up a lot. Did I say there was a portfolio review somewhere? June portfolio review. That's not the one we want to look at. July portfolio review. So in the July portfolio review, Money Talk, short-term portfolio. We were at 349, and now we're at 443. So we're up $100,000 in the short-term portfolio. Those are our hedges. That's how we hedge our portfolios. So the long-term portfolio was, where are you? Nope. Good God, that's a lot of positions. Nope. There it is. So the long-term portfolio was 2 million flat. That's easy, right? So the long-term portfolio was 2 million. And now it is, drum roll please, 185. So we lost 150,000 in the long-term portfolio, but we gained 100,000 in the short-term portfolio. That's exactly what it's supposed to do. That's what hedges are for. It offset the damage. Ideally, you want to offset about half the damage. And wow, yeah, so we're down 500 points, 2.7% on the NASDAQ. But also you have to realize that right now, the volatility, the VIX is way up. So we can do that. If I can find it, futures, indices, there's the VIX. See how the VIX went from 13 to 16.5? That's a pretty big move. And hourly, we're up 10% today on the VIX. So the VIX is bad for the long-term portfolio. High volatility is bad because we sell a lot of puts and calls, and it drives up the price of the puts and calls that we sold. And that's a negative to us in our portfolio. So in the midst of a big move, the long-term portfolio is going to look worse because we sell a lot of premium. So some of our other portfolios, because we sell a lot of premium. When that premium calms down, the apparent loss, the unrealized loss of the portfolio will also calm down. Now, in the short-term portfolio, we also sell premium, but not so much. And in fact, fortunately, we just here made a couple of moves that were actually to remove some of the premium sales. And this is what you got to do. You have to be aware of how you're going to make money in a move. So I had said, I think for 1950, we can buy back the short January 25 calls. So in other words, we had these short January 25 calls for 1,950 bucks. And not that they were going to go in the money, not that we're going to go from 7 to 25. That's very, very, very unlikely. But the point is, they're already up 88%. And it's a convenience thing. So in other words, since we were anticipating a drop, a pullback on earnings, we bought them back so that instead of them going up in value and being annoying to us and making us not want to sell as many short calls, we now cleared the table, and now we can sell other different short calls for a good price. And plus 25 was, wouldn't be our choice to sell. Since we've rolled our long calls down to 5, we'd probably rather sell the $20 calls than the $15 calls, not the 25s. They're way too far out of the money. All right, and here we have the $15 puts. That's not really our target, but we're going to roll those when we have a chance. And then on TZA, what do we do to TZA? Oh, on TZA, we rolled the $15 calls to the $10 calls, and that puts us in the money, right? In fact, now we're $4 in the money. It puts us in the money, and it also gives us a better delta. So in other words, TZA. So we had the oh my God, showed too many. All right, so we had the $15 calls, and they have there's no delta here. Come on, are you kidding me? Custom quotes, options, theoreticals, and Greeks price. Seriously? What was I thinking of that they should be better? Custom quotes, instrument details, option theoreticals. Oh, layout. There you go. Customize. I want the last. Don't want the net change. Remove that. I want not the bid size. I do want the delta. And I've got the last. Where's bid? Where's a regular bid? Ask size, bid size? That's not what I want. Am I crazy? I mean, shouldn't there be, oh, maybe if I do this. Basic and, ah, ha, 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 ha. There you go. So last X is correct. No, that's still not the one I want. No, it's not theoretical. Nope. Basic price and quote. Son of a bitch. Oh, size. Bid. No, not size. This is, I don't know, maybe it's a language problem. I want the bid and the ask. Custom 1, custom 2. Instrument details, options code, option theoreticals. It's not a theoretical, it's a bid and the ask. See what happens. Oh, see, it's still there. Oh, I guess bid and, oh, so bid and ask is not a variable. It has to be there. All right, last in delta. Where was I? All right, we were in the 15s. The delta on the 15s is 58. We roll down to the 10s, and the delta on the 10s is 75. So it's 20 more. So we pick up, rather than 58, it's 20. We're picking up 30-something percent, 35, 40% more than we would have if we hadn't done the roll. That's the key to that. That's why we do the roll. It's a double benefit. Obviously, you have the intrinsic value, which is good, but also when we do get a move, we capture a lot more of the move up. 75% of the move up is captured versus 58%. That's the key. And frankly, this was probably 50% before we made the move. So that is what justifies that. And that's why we wanted to roll from the 15s down to the 10s. And as it works out, so now we are $4 in the money. And again, now in this case, these guys are so far out of the money that they're not really worth this set that's the 45s. These are not even in consideration. That's why we left them there. They're 202, 645s. We're not going to get from 15 to 45. That's a 200% increase in this, which would mean a 70% decrease in the Russell. Right, for 3 times ETF, you'd have to get a 70% decrease in the Russell. I don't believe the Russell is going to go to 70%. And frankly, if the Russell does drop 70%, we got bigger things to worry about than the fact that we didn't make money on our hedge. We're all going to have. It's like 2008, right? We were thinking like the world was ending. It was like incredibly bad. It was like the collapse of civilization was imminent. We weren't too worried about whether or not the Russell was making us money. Oh, I will never forget that. I went to Washington and met with the Treasury Department, and they were asking me whether I had any good ideas. I was like, oh man, we're in trouble. I'm like, really? You have to ask me what I think we should. This government is scary. Anyway, so good. Everything's working the way it's supposed to work. That's very fortunate. And we're in good shape there. Let's see if anybody has any questions. Nobody has any questions. Fantastic. So have we talked about what we need to talk about as far as things are going for earnings? Yeah, so in the limited amount of information we have so far, it's going pretty much like we thought. It started off well. But now we're going to start seeing where the warts are, and those warts are going to be very scary, especially for the NASDAQ, which was getting towards 40 times earning in the average prices. And that doesn't tell you the full picture, because 40 times earnings, including the Magnificent Seven stocks, which are up 52%, 56%. That the four stocks, anyway, the four stocks: Amazon, Google, Meta, and Nvidia, not Tesla, not Apple. All right, so not Tesla, not Apple, and not somebody's missing. Microsoft. Microsoft's not included there either. I think they're making a lot of money. Anyway, so without Microsoft, Apple, and and Tesla, those four stocks are up 56% in a year in earnings. All right, that merits some consideration. But do we think that they're going to be up another 50% next year? Or are they just benefiting from, and it's mostly chip sales for AI, cloud services for AI, and Meta somewhat with the cloud, but they're also, they've just been in a very good environment for traffic and so on and so forth for Facebook and Instagram and whatever else they own. They own a lot of stuff now. So they're also doing cloud services. So these companies are directly benefiting from AI and making a fortune of money that's found money. It's money that wasn't there before, and now it's there. And they are the industry leaders in that kind of stuff. The rest of these guys, and I've said this a lot, they're not benefiting from AI. They're spending money on AI to keep up with everybody else who's spending money on AI. It's a treadmill to nowhere. The same thing as the internet was when we started it. You had a perfectly good company that had a catalog that sold shoes, right? And then all of a sudden the internet comes along, and now there's shoes.com and Shoespace and blah, 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 and all these different things on the internet that are nowhere near as good as you, but they're available on AOL, and these guys are advertising. Instead of sending out a catalog like you do every quarter or every year at Christmas, whatever it is you do to promote your shoe company, all of a sudden these guys are emailing all of your customers 5 times a month, and constantly in their face and constantly saying, hey, if you need a shoe, call us up. We'll give you a better price. We'll do this, we'll do that, because they don't have to have a store. They've just got a distribution warehouse somewhere in the Midwest that takes care of the entire country. They don't have salespeople, this and that, and they're kicking your ass. Even if your shoes are great, even if your customers were totally loyal, they were shaking everything up. So defensively, you've got to build a website, and you've got to start dropping mail. This is why email expands so rapidly. You've got to start emailing your customers 5 times a month. And you've got to tell them you've got the best deals and so on and so forth. And you've got to cut back on your stores, which is what kills the malls, right? You've got to cut back on your stores so you can save money and compete. And you've got to build yourself a big ass warehouse in the Midwest. Although Amazon fixed that, so now nobody has to build a warehouse. And this is where it all fell apart for the Midwest. Nobody has to build a warehouse in the Midwest because Amazon's already done that. So, so they're now telling all of their retail clients they can put their stuff in the Amazon distribution center. Not for free, of course, but they're taking over all the warehouse money. And this is how you have this rolling nightmare. Now, in the end, does it benefit the shoe company at all? No. Does not benefit the shoe company at all. He used to have very fine shoes, and people would buy them for the holidays. It's a normal thing. Look at his catalog, pick up some shoes, have them sent out or whatever, and he was a happy camper and everything was great. Now there's 45 shoe companies. None of them make any money, and they all have to pay web designers to have websites and e-commerce and blah, blah, blah. Now they have to hand over a portion of their proceeds to Amazon, who's sticking their beak in, because now everything has to be delivered instead of people coming to the stores, and they've laid off all the salespeople. This is what happens. And that's why, by the way, when people talk about, oh, AI is going to take everyone's jobs, yeah, well, it's only the next thing that takes everyone's jobs. Electricity took everybody's jobs. Then industrial machines took everybody's jobs. Then the internet took everybody's jobs, and now AI is going to take everybody's jobs. Somehow there are more jobs. There's 165 million people working now. There weren't 165 million people working 100 years ago. So somehow or other, we added more jobs, even though all these different things happened in the last 100 years that cost people their jobs. Let's not forget, colored people and women took your jobs also. Used to be white men. Like, watch Mad Men or something like that. It's like the only people who worked were white men. That was basically it. They had the jobs. All of a sudden now they went through hell. They went through these poor. You wonder why they're angry, right? You wonder why they're angry wearing red hats because first it was first it was electricity, then it was machines, then it was the unions came along, and that was another nightmare. Then it was the influx of immigrants. Then it was Then it was black people were able to work. Then women were able to work. That was insane. Um, oh, these poor guys. And then they think they've got a handle on all that stuff, and all of a sudden the internet comes along and wrecks everybody's business and throws everything out of kilter. And now robots are coming. So yeah, they're angry. Yes, they're angry, and they're blaming immigrants, and they're blaming whatever, and they're wearing red hats and shouting at rallies. This is what always happens. Rome started falling apart because they were in this constant expansionist war. Before Caesar, they were in this constant expansion war, and they were constantly getting new territories and capturing people and bringing back the wealth of the nations that they conquered. They would take it back to Rome, all the accumulated gold, jewels, blah blah blahs, right? And their people as slaves, and they would put them all to work in Rome. And so the Roman citizens didn't have to do anything. It's just money kept pouring in, and they kept getting slaves thrown into the slave pits for free and whatever. They put the slaves into the Colosseum, and they were entertainment. That was their show, was killing slaves for fun in front of the people. So that was all great to the extent that it was to the extent that you were not one of those people. And then Caesar comes back with his armies, and they're like, we're hungry and we want jobs. And it was a lot of freaking people. I don't know what the population of Rome is compared to the army, but it was a sizable amount. Hang on a second, let's find out. What was the population of Rome versus the size of the army when Caesar came back? How large was Rome's army? Rome's army, 450,000 people. What was the population of Rome? 1 million. There you go. You can see what the problem was, right? So these men have all been told that they are going to be. In fact, that was why they went, right? All the poor people of Rome signed up to be soldiers because they were told, you will be Roman citizens. We will make you citizens. What were citizens? Citizens were the people who sat around with the slaves, never had to work, got money, the wealth of Rome was shared with them as a conquered people. And obviously not all 450,000, 5 million people in Rome weren't rich. They weren't all citizens. There were a lot, but the total population was 1 million people. All of a sudden, 450,000 guys whose experience in life is soldiering come back to Rome, where they're supposed to be made citizens, and they don't know anything they don't know any living other than murder and mayhem. Because the army was a lot more murder and mayhem back then. It wasn't quite so nice as it is now. and they got to go, and they got to be employed. And then Rome couldn't afford to feed them. That was the next disaster that they had, and that happened pretty quickly. That was that whole Mark Antony Cleopatra thing with the grain shipments and all that. That was, the whole point of conquering Egypt was to keep the grains flowing from Egypt to Rome. That was their breadbasket, basically, was Egypt. So, and Caesar's most trusted general is Mark Antony. Sent him off to Egypt. And Mark Antony fell in love with Cleopatra, and whatever the hell happened there, big mess. Anyway, so the point is, you got from 1 million people to 1.5 million people. All these soldiers were out eating off the land in foreign countries because Rome was fighting a war on every possible front. And their armies got so stretched out that Caesar was smart because he didn't make the same mistake Genghis Khan made. Genghis Khan also conquered a similar sized territory, but it got so big that it was ungovernable and everything started falling apart. And especially because Genghis Khan left just as he was on the verge of going after Europe. I think his son died or got sick or something like that, and he went back to be with his son, and that was the end of it. Then everything started collapsing because without him, the guy was brilliant, and without him organizing everything, the whole thing was too much. Caesar was the same. He was the focal point of the army and all the plans, but he withdrew and brought back the soldiers. But the problem is bringing the soldiers back to Rome. Thing he didn't realize is now you got to feed them. And did you make your supply line strong enough, and his commerce strong enough, and his trade strong enough? The answer is no. There was not enough time in his life. He just conquered those people. When he was done conquering, he goes back to Rome to reap his rewards for being a conquering hero. But meanwhile, now he's brought this disaster with him of way too many mouths to feed. So that was the year 2000. I'm sorry, year zero. That was the year zero. And and then 1800 years later, 1900 years later, we have the same problems. We didn't learn anything. We have the same thing. We send people off to war. We gave the women jobs, and then the men come back, and the women are like, "Well, we work now." It's like we're not going to all go back home to be house slaves. We have jobs and money, and we feel a sense of independence, and we're not necessarily doing that. And the Black people who were finally allowed to integrate and have jobs and work alongside everybody else and so on and so forth, because you needed that for the war. They also were like, well, what do you think? We're gonna go back to being sharecroppers because you came home? And then there's just more competition for jobs and more people looking for work, and the industrialization is kicking people out of work and so on and so forth. It always happens. Thousands of years of human history, this is how it works. Can you imagine 1 million inhabitants? That's it. The Roman Empire. Okay, so we talked about that, and now we should talk about me catching up on stocks we like. Phil's post. Let's start there. So we've been doing the watch list. That's not the watch list. That's the watch list. So let's see how we've been doing. That's a good question. It's been a while now. It's been a couple of weeks of doing this. So we've been watching ADP holding up okay. ARCC, no. BA, no. BBY, moving up. BCS, too far up. See, getting away from us. Blackstone Mortgage Trust, uh-oh, what happened there? They were doing good, and now they're all the way back to where we started. Oh, I even said that. BXMT currently at 18, so it's back to where it was. What happened to Blackstone? I have no idea. I imagine they had bad earnings. BXMT. Do they have earnings already? Yep. Ooh. July 24th, they just had earnings. So EPS was up 10%, but the gap, see, the gap gets you, right? Look at the gap with a loss. That's awful. And the revenues were down 2 points. So it's not the revenues down 2.7%. That nobody cares about that. It's what did they do with their earnings? What was the problem? Quel dommage, as they say. Blackstone fund slumps, empty offices intensify pressure. See, this is why we like a watch list. So we watch things and find out more information. So this is very interesting. So this is my overall premise of why we're not into many of these real estate trusts or any kind of commercial real estate. I thought they would do better though. Commercial real estate company Blackstone saw shares drop 10%. Firm cut its dividend 24% in the face of continued strain. It is the latest sign of mounting woes, blah, blah, blah. For Blackstone to come out and have dividends, I have to imagine it's going to weigh on people's mind. Oh yeah, no shit. Wouldn't surprise me to see ripple effects throughout the industry when the biggest player is having to cut dividends. Blackstone recorded a $140 million net increase in reserves. So it's not a real loss. They reported $140 million increase in reserves towards expected losses. So it may be better than they think, and they'll get that money back at some point, but they just basically took $140 million, assuming a much worse case than they're at. 55% of its US, 50, and this is what I keep telling you guys, 55% of their office space is watch listed or impaired. Wow, 55%. So 55% of their office space they believe is going to take a hit. That's horrendous. That's worse than we were talking about. But remember I was saying that? I said that you gotta understand that these leases, people, COVID came and everybody starting at COVID, which was what, 2020, right? So in 2020, you have the average office lease is more than 5 years. Some of them, a lot of them 10 years. So, in 2020, you got 5-year, maybe 3-4 year average office leases and suddenly half your office is empty from COVID. That doesn't change your rental agreement. There's nothing in the language of your rental agreement that says if people have COVID, you don't have to pay your rent. So rents continue to get paid. The government put on programs to make sure rents get paid. Why? Because it supports the banks. The government, that's another way the government gives money to banks. Most of the function of government is to give money to banks. It's like the main reason it exists. So they gave the money to banks to make sure that they don't suffer any losses just because economic conditions were not what they bet on. That's the difference between a private lender and a bank. If a private lender makes a loan and expects conditions to be a certain way and they're not, the private lender loses their money. If a bank bets on something and makes a loan and because conditions should be such and such and it doesn't work out, the government says, oh my God, you poor bank, here's your money back. So anyway, nothing bad happens to the banks at all during COVID. Their borrowers take out loans or get government grants or so on and so forth, but the money keeps coming to the banks. Meanwhile, though, now finally, after 4 years of elapsing, these leases start coming up for renewal, and the lenders, the property companies, start going, we're in trouble now because we still hold these buildings, and now people are not renewing the contracts we have with them. We had an anticipation that people would roll over their contracts and renew. That's what they usually do, but they're not, because they're saying, oh no, I only have a 50% occupied office, so I either need 50% less space or I'll pay you half for the space I'm in. And if you don't like it, I will go down the street where there's a half-empty building over there that they're going to be thrilled to have me come in as a tenant. So that's why it's like a rolling disaster. It takes a long time to gather steam, but when you start seeing companies like Blackstone make moves like this, and you say, well, it must be time to start reconciling. Investors deeply worried, coming commercial space collapse. $1 trillion of $4.7 trillion of outstanding commercial mortgages are due in 2024. 1 trillion, 20% in 2024, according to the Bankers Association. This looming maturity, so they're responsible for 10% of it right there. The looming maturity comes against a backdrop of declining property values and lower rent growth. Blackstone cut its dividend to 0.47 down from 0.62. That's really still fine, you know, considering where they are. And the company is also authorized to $150 million stock buyback. So they're buying back their own stocks. They're, you know, to some extent, they may be purposely worst casing everything because they want to lower the stock price so that they can buy a bigger percentage back. Because yes, because Blackstone are those kind of bastards. So yeah, they'll do that. They will manipulate the stock, make a worst case scenario, scare all the retail investors out. And when I say retail investors, the people who invested in their company, the good people who took their money and invested in Blackstone, assuming that their management and so on and so forth would take care and skillfully steer their investment through troubled waters. No, that's not what they do. What they do is they throw the anchor over the boat, they scream that we're sinking, and then as soon as all the retail investors bail out, and they go retail investors first, and they give life jackets to all the retail investors. Once they're in the water, they go, oh, all we got to do is pull the anchor back up and we're fine. So that's the dynamic that's going on there. The looming maturity comes against backdrop, blah, blah, blah. I said that. The company reported quarterly loss of $61 million, which is nothing to them. Loan resolutions will unlock earnings potential over time. And the office sector gloom extends to the entire industry. In February, KKR slashed its dividend amid souring loans. So yeah, they're souring loans and so on and so forth, but you could have spun, the fact that they're taking $150 million and buying back their own stock while this is going on should make you really think about what's happening here. Really think about it. Let's see if we can go to Blackstone for a second. Oh, why don't you have a link? Oh. Well, we're in Blackstone here, right? BXMT. All right. So current PE, because they wrote everything down, is ridiculous. Forward PE is 8 or 9. The dividend was 14%, and they cut it by whatever they said, 25%. So now it's still 11%. So it's really still a huge dividend. And don't forget, if you buy it here and it goes up and they replace the dividend, then you're still making great money. So now to me, this is going to be attractive. They've already taken the loan loss provision. They've already taken a provision that covers them for what they expect to lose. The market cap of the whole company is only $3 billion. They're buying back 5% of their own stock with the money that they're not paying out in dividends. It's pretty slick, actually. So if we look at a longer term chart of Blackstone, you can see that this is a pretty solid base. This takes them through crises. Don't forget, this is when they had no tenants and COVID, and they had no idea if we were even going to open back up or what was going to happen, and it bounced off of 15, and now we're back to 15. So I like them here. And how do you play it? If you go to BXMT, yeah, they have 2026 options. Good. Okay. So you take advantage of the dip. It's $17. You can sell the $15 puts for $2, or we could sell the $18 puts for $3.50. I don't know if I'd do that. 18s. I feel, for me, this is free money. If you're going to tell me you're going to net into Blackstone for $13, then this is free. This is $2 for free. So you sell the puts for $2. You buy, where are we at, 17? You buy the $15 calls for $3, and you sell the $20 calls for Well, it says $1.05, so figure it, yeah, so figure a buck. So now you're net 2 on this $5 spread. So Blackstone's at 1740. You're in for net 2, but it's not really net 2 because you sell the puts. You're in for net 0 on the $5 spread. And that $5 spread is $2 in the money. That's the way to play it. Right? So you do that, and you're gonna and if Blackstone recovers, you're gonna have a huge windfall. So we don't have to own the stock. You're promising to own the stock if it does go any lower, because we sold the $15 puts for $2. But the worst case scenario is it's net 0. So the worst case scenario is we own Blackstone for 15. 15 is significantly less than it is now. So almost 15, 20% less than it is now. And that's your worst case because it's been net 0 on the spread. And so the worst thing that can happen to you is you own Blackstone for $2.50 less than the current price. And then you buy more and you double down and so on and so forth. So easy play should definitely be included in some portfolio at that point. And that's why we have a watch list. We have a watch list so that we can see stuff like that and go, oh, look what happened to Blackstone. Let me check it out and say, that's not so bad. What happened to Blackstone? They said we're not going to pay this insane 12, 13% dividend. We're going to pay a 10% dividend. And everybody's like, run away. That's not that bad. And what else did they say? They said, we're going to plan ahead and say that just in case, we're going to put $140 million aside to cover any future losses on unpaid loans, on unpaid, any unpaid buildings and things and any transitional issues we have. We're going to save money there. It's like, okay, and we're going to buy back $150 million of our own stock. And what does that do? That gives you a 5% boost on earnings, right? Your earnings per share is going to go up 5% when they buy back and retire 5% of the shares. So they're giving me a 5% boost on the per share price. They've taken an insurance policy of $150 million against lost revenues from the buildings that they already have, and they're paying less of a dividend, which was getting to be a silly amount of money anyway. These are all good things. And so in that case, do I want to buy Blackstone not for $17? I'll buy it for $15 down here. I'll agree to that. Here's Cheesecake Factory having their issues. And again, I should really use a 1-year chart so I can see where the earnings come in. That's kind of probably smarter to do. CIM, I love these guys. Another REIT, love them. Cleveland Cliffs, love them. Still cheap. Crocs got cheaper. So certainly worth a look, but you always have to do that. You got to re-examine and re-look and make sure that you're still happy with the premise. CRISPR, we definitely wanted to wait for earnings on them. Disney, patience pays off, cheaper and cheaper. All right, okay, that leaves us with strong performance in streaming and theme parks. Theme parks have been having problems. Recent management changes, including the return of Bob Iger, that's obviously happened. Ongoing cost-cutting measures and restructuring efforts. The big problem with Disney is they're spending a fortune building and expanding the parks to justify the insane revenues that the fees that they're charging for the parks. I talked about that this morning. And at 80, I still want them. At 90, I'm not jumping all over them. Ford, I like them. Future Fuel popping up a lot since we started on it. What did we say? 406? Look what the frick cap. Oh no, currently 495. So from 5 to 559. Originally, we were at 406. That's why it's good to have these things in here. Foot Locker is moving up quickly. Gilead blasting higher. Blast 68. When we put the Century in, it's now 73. GNRC, I love what they're doing. I would like to see their earnings and hear more about it, but they are building backup generators for electric cars. That's a good thing. Basically, let's say it's $1,000, right? But $1,000 means you can add a little generator in your car that would run on fuel, hydrogen or regular fuel or whatever. Probably various fuel inputs. and you have this backup generator in your car, if they can make it a reasonable size, that'll give you an extra couple of 100 miles on your engine. How cool would that be for 5% more than the cost of your car, or not even 5% more than the cost of your car? I think it's a great idea. Gold. Again, gold is now at record highs, all-time record highs, 2,400. It's just consolidating for the breakout. So this is one you don't want to wait too long on. Honeywell already blasted up. IMAX, I just put out a top trade alert for IMAX yesterday. I mean, it's like, do not miss this one. International Paper's been popping already. IVZ poppings after we talked about this. Here's the problem when we talk about stuff. This is a members only post, but we got to be, sometimes the act of talking about it causes these things to go higher. Jack in the Box was stupidly at 48.70. Now it's come back to 56 already. Nordstrom, and I'm talking like, what, 2 weeks ago we were looking at these things, right? We started doing it. Nordstrom's 22.72. It's actually lower, so still viable there. KLG is the cereal part of Kellogg. They were 16.10, now they're 16.50, so no real change there. KHC, much on sale at 32, coming up a little bit. Coca-Cola just had great earnings, so they were popping themselves. Leibu, the biotech, given how strong everything else is, I don't see the point in, I wouldn't bother putting money into this because we have so many strong candidates to play with. Levi got cheaper, so that's definitely worth considering. I think that's Lean Forward they call themselves now. I don't know. It used to be Rewalk. I like these guys still as a penny. It's a penny stock play. Throw a few $100 at it, see what happens. Lovesac, fantastic. Still at the same price. Las Vegas, we talked about this. I said I am worried about the Macau. So not something I want to get unless it gets super cheap. Medtronic, I love them long term. 77.50, it's 95. They're up to 80 already. MGM, less exposed to Macau, less China exposure than Las Vegas Sands, but still, I don't like it. We talked about this. I don't like it because it's too hot. It's too hot in Vegas. It's too hot in Disney, in Florida, Disney anyway. It's unpleasant. If it's unpleasant, you're relying on this, and this is the problem when you upscale your clientele, right? Poor people go where they can afford. And they used to be able to afford to go to Las Vegas. They used to be able to afford to go to Disney. That is not the case anymore. A poor person cannot afford to go to Disney. It's not a possible vacation for a poor person. And I mean poor, I'm honestly meaning below the upper middle class. And the same goes to Las Vegas. Las Vegas, yeah, they still have some cheap hotels, but there's not a lot of fun things you can do in Las Vegas without spending money. It's like Disney, because once you get in the park, assuming you can afford to get in the park, once you get in the park, everybody's got their hands out, and every step you take costs you money. And Vegas is not much different. Vegas, the drinks got expensive, the food got expensive, all the entertainment venues, the shows got expensive. It just got really out of control. So you lose the people who used to come again and again and again and keep the place full and keep it lively, and you turn it into like a tomb. And not only that, though, but now it's 120 degrees. And the rich guys from Europe that you're catering to in Las Vegas and the rich people in America that you're catering to do not want to go to Las Vegas in the middle of the summer. I had this conversation with my kids because we went to Las Vegas one time in the summer and they said they'll never do that again. It doesn't matter if you hang around the hotel, it's freaking hot. Everything's hot. It's not fun to go out. It's not fun to walk somewhere. It's not fun to go around. It's ridiculously hot. And that's not a vacation spot. That's a funny thing. There's a new dynamic now because now people who live in warm climates, when they go on vacation, they want to go somewhere cool. My kids want to go to Canada for a vacation. My kids want to go to Montreal. They want to go to Toronto because it's like 70 degrees there. They're like, ooh, that's a vacation. Let's walk around Toronto and get some food. Middleby still hanging around at the low points. MP still super low, got cheaper actually. Moderna still cheap. Metal Steel still cheap because we just looked at those. What the hell were they? PPIs. The PPI numbers in Europe are dreadful, so I wouldn't be jumping on that one. Nike, I would be jumping on this one. They still getting cheaper though. NLY is another good REIT. OLN, Chemicals, good one. Paramount, let's not even talk about Paramount. Rocket, where did we get it to last time? S, right? Rocket's getting up there a bit. Restoration Hardware, jagged, very jagged, not performing well. But I love them. I mean, we got to look at the earnings. That's what I think I said about that. They pull back a bit, trading 28 times earnings. Yeah, that's why it's not that cheap. But we still want to see if the earnings are working. If their plan is working, it can become cheap in the near future. That's the thing. Rio Tinto, I think Rio Tinto just got upgraded. So that's kind of weird to me that they're still down here. SoFi, big sleeper stock, should absolutely be in a portfolio. Sony, a little tricky, went down a bit. I don't know if that was earnings or not, but they went down a tiny bit. Gotta look at the slate of movies also when you're looking at these things. Simon Property Group is the malls. Malls are not, it's an advantage to them because these malls, they know how to manage them, and they pick up these dead malls, refurbish them, and turn them into a higher end malls, which still get people to come. Okay, so this is where we were up to, I think. Oh, did we finish the S's? Were we up to the S's? I don't remember. Does anybody remember? What did we do last time? Bernie says Lockheed Martin is shooting up. Thoughts on Microsoft earnings? I haven't had a chance to look at Microsoft. Just remind me in chat. Lockheed Martin is, of course, great. I don't remember if we did the S's or not, so I guess we should probably be redundant here. I'm pretty sure we did because I remember talking about SoFi. Anyway, good little online bank. Very big advantage of not having to have actual branches or anything. Speaking of progress, it puts people out of work. You don't need tellers or anything anymore. You don't need tellers. You don't need buildings. It's kind of weird if you think about it, because we don't have money anymore. So what's the bank for? What's the purpose? Money goes, you electronically deposit your money, and the money is electronically transferred to wherever you want it to by your banker, and nobody has to say hi to you, and nobody has to do anything for you or anything in the bank. It's just, you're putting your money in a place. And so they make offers that make it realistic. So obviously they're going to do well. Why would they not? If we see their accounts are still growing, the trick is it's a saturation point. They're very appealing to young people. Like my kids, I like a bank. In fact, I use TD because they're there on the weekends. I like to sit down with the guy and do the things and make sure everything's been taken care of. I don't like to just get online and do my banking. Doesn't feel right. But that's because I'm old. My kids are like, what do you want that for? Why would I go to a bank? They think it's the weirdest thing to like go to a bank. When I introduced them to my banker when we first opened accounts, they thought it was like a horrifying thing. So Sony, want to look at the movie slate, you want to look at the gaming slate, and I think the gaming division is a problem for them. I think that's on the way out because people are not specifically buying devices to play on anymore. I know they do, but not the default. And talked about Simon Property Group, Stanley, of course. There's always going to be a demand for their stuff. So I mean, it's a good perennial stock. When it's this cheap, why not, right? Synchrony Financial is another one. Look at these guys go. Holy shit. Wow. So they're plowing up. And I've done, these are all ones I've done recently, so it's different. AT&T, we just talked about, ridiculously cheap. 1521, now it's back to 1913. That's crazy. So they're doing good. Target, oh, AT&T, you know what benefit AT&T? They just had their earnings. The big benefit for AT&T is that people are not getting new phones. They're keeping their phones longer. That's great for AT&T because when you buy a phone and AT&T gives you a service plan, right? They're writing a check to Apple for the price of the phone. Apple's getting paid. AT&T's the one giving you the bonus and doing the financing on the phone for you. So the incentives are coming from AT&T, not really from Apple. So AT&T's got the iPhone deal and whatever. So when people are turning their phones over less often, so in the AT&T, you have a contract plan that says every 2 years you can upgrade your phone and so on and so forth. But if people are taking 3 years to do it, that means that you're paying them the full price of the leased phone, even though you already paid off the lease. You're still paying them the same freaking agreement. Maybe they take something off or whatever, but you're still paying the monthly fee and they don't have to give you any incentives. That's fantastic for them. And that's nothing evil. That's just the nature of the cycle is the new phones aren't that exciting. And a lot of people are saying, they look at the new phones, they're like, I'll wait for the AI one to come out or something like that. It's like, it's not a big deal to change your phone anymore. And they last well, they're made well, so people aren't jumping to get a new phone constantly, which is great for the phone carriers. But not so much for Verizon. But Verizon had a super duper aggressive thing trying to get market share from AT&T. It was not very successful for gaining market share, but they did have to give a lot of people phones, watches, iPads, all kinds of stuff because they had a super aggressive thing around Christmas time. And it went into the first quarter. So they've got a lot of carryover costs. In fact, actually what they did is they probably took away the customers from AT&T. The ones who were looking to switch got a better deal from Verizon than they were getting from AT&T. And so AT&T lost the customers who were likely to switch. Verizon took away the more aggressive switchers and left AT&T with the people who are more stable. So that'll work out for them. Target hanging around low. We wait for earnings, but we'll see what happens. TNDM, Tandem has been flat. It's diabetes care. I like their whole process. I think they're a great long-term play. And Trox makes titanium oxide, which is super specialty. I love them long-term. I think anytime industrial production comes back, they're there. And even when it's in a trough, they still are one of the few people selling this stuff. It's always a good bet. All right, so that's where we are at the moment, and we're at T. So everybody remember that we're up to T, and I'll still be going through this stuff next week. Oh, it feels like forever. And even when I get to the end of the alphabet here, which should be the next thing we do, should be the end of the alphabet. Then we've got to start adding things. We're going to start adding new things, which is going to be a nightmare. So much as I love all the stock stuff, it's just the actual putting the stuff together is crazy. But it's worth it because we use these things for a year at a time. These watch lists are incredibly useful. The ability to just go through this thing like we just did and say, here's, this is still good, that's still good, that's good. Here's this one, check this one, make sure this didn't change. That's the whole point of this thing. And in fact, today, as an example of how this works, it's kind of weird when you look at the all the images we put on the site, right? Don't even get me started on wealth inequality and things like that. It's just insane. Not gonna talk about that. Here's Tesla, terrible. Here's Google still not recovering. Visa. Visa was down a bit. AT&T is the only person who actually did well. Who am I talking about here? Disney. Oh, give me saying Disney is deserve, should be okay. Oh, yeah. So Japan's PMI contracting, Eurozone PMI even worse. Our PMI contracting still. New home sales. This is an important point. Only 617,000 new homes are being sold. There's 110 million total homes. So it will take 178 years to replace our 110 million homes at this pace. You know that's not right. We don't make homes that are going to last 178 years. That we just don't construct our homes that way. They are 40-year teardowns in general. 60 years is getting outside of a home's reliability zone. And we've got a lot of old homes all around the country, plus the storms are getting worse, the flooding's getting worse, tornadoes are getting worse. They've got category 6 hurricanes now, which is 200-mile-an-hour sustained winds, which is more than usually that even in hurricane-prone areas, they'll only put up to like a category 4 is mandatory. Now we're going way past the category 4. So we could have hurricanes that knock out 10,000 homes, 20, 30,000 homes at a time. We have a housing crisis now, and with this number of replacement homes being built, it's going to get worse and worse and worse. It'll snowball into the future. And we're going to have a tremendous housing shortage, and it's going to be a great time to be a homeowner and a horrifying time not to be a homeowner, because there won't even be a home for you to go to. There just simply isn't going to be enough inventory. Oil had a huge build. What happened to oil the rest of the day? Let's see. Pairs, not pairs. Active. Ooh, even the Russell's taking a hit today. How's that for awful? CL. Nope, still 77.50. Weird though. We had a huge draw. I don't know what they could have possibly wanted. I guess we can take a look. Let's take a look. PETOL, petroleum. July 19th. Today is the 24th. That sounds right. Oil imports, a decrease, blah, de blah. Oil imports average, don't care. Crude oil inventories decreased by 3.7. Gasoline decreased by 5.6. Huge draw in gasoline. Oh, that's important too. Oil inventories are 5% below last year. Gasoline is 2% below last year. Distillates 9% below last year. That sounds like we're pretty tight on oil. And propane, polyethylene increased by 1.8 million barrels. So then let's look at the total. Don't let them sneak it in on you. Where is the frickin' plus on this thing? Up there. Okay. So what's the reality? You know what's funny though? The reality, look at this. We only went from 669 to 665. We only went up 4 million barrels. It sounded a lot worse than it is. Why is that? Because look at all other oils. There was a build in all other oils of 8 million barrels or 5.5 or 7.5 million barrels. All other oils is not counted in the reports. And that's what they do when they want to fudge a report, when they want to jack up the price of oil and make it seem like there's a big draw. They shove into all other oils. The refineries make oils that are not counted, in the report in order to make you think that there's more demand than there is. Not only that, but Joe Biden bought some oil too. He put some oil in the Strategic Petroleum Reserve. So bottom line, we are product supplied. We are not supplying any more product than we did last year. Okay, we are importing less than we imported last year. Last year we imported 3 million barrels a day. Now we're importing 2.6 million barrels a day, 2.666. And that means that 3.333, I don't have a calculator. Calendar? No, calculator. So 7 times 3, no, 0.3. 0.333 is 2.3. So we're importing 2.3 million barrels less. We're exporting 200,000 more, which is another 1.4. So plus 1.4. That's 3.7 million barrels net. And you can see that here. It's five, and that's what it is. 500,000 more net is being exported. So 500,000 times 7 is 3.5. Same thing. So we're exporting 3.5 million barrels more. Our refineries are making the same amount, so it's netting a draw. It's completely artificial, though. It has nothing to do with demand. So these numbers, these draw numbers, have nothing to do with demand at all, because especially because of this all other oils build, the net of products is the net total of oil is this number, which is 4 million down, right? 4 million down, but 3.7 million of it has been exported. That's what you got. So there is no real change, and that's why oil, and the oil people know this, that's why there's no reaction. They know what's going on. They know that this is bullshit. They try to get something going, but they can't because everybody's heading for the exits on oil. Because we went through July 4th is over. That holiday's gone. The next holiday is until the end of September. Where is your demand going to come from? Where's the real demand going to happen? You know, the war is a big nothing. The Red Sea, remember the blockade of the Red Sea and the Houthis attacking ships and blah, blah. Whatever happened to that? That just faded out. I don't think it got resolved. I think everybody just got tired of it. And then you got Ukraine is just chugging along year 3 or whatever the hell it is for poor Ukraine. Those guys are so screwed with this Vance guy. Holy crap. Oh, go away. He was very vocal on the House floor trying to block aid to the Ukraine when we were giving the aid, when we were putting that package together. If that dude's vice president, we're going to have some serious problems. And Trump too, because Trump's a little Putin puppet, so he's gonna head over to Russia and sign over the Ukraine to him, basically. That's gonna be a hard show. I mean, you gotta remember, Russia stole Crimea already, and nobody did anything about that. They just took it and sat there, and nobody punished them. So of course they got more aggressive again. They said, well, that worked. Now let's take the rest of the country. And now Trump's solution that he says he's going to have on day 1 is going to be to say to Putin, okay, you keep what you took and then stop, which is half the country. And no punishment for having, killed all the people and doing whatever they did to get there. Just, hey, have fun. Enjoy your acquired lands. It's very bad. Terrible too. I meet a lot of Ukrainian people. They're so nice. It's just a real shame. Where are we? All right, good. So that's it. So I'm in good shape. It's 2:45. I think I can relax. All right. So that's where we are now. We're going to go through some more earnings reports there. The watch list is super useful. Oh, no, wait. I'm sorry. I forgot. I was going to get further than that. I got distracted by oil. So we looked at Tesla. Robo John says they suck. So we're going to leave them alone. Swamp Fox was talking about HPE. They're fine, chugging along. Whoa. Am I hallucinating? I could have sworn we found a stock to pick. Wow, that's weird. You know, somewhere in my mind, I thought we picked a stock to add to a portfolio. Where did I do that? That's going to bother the crap out of me. Did I do it in the wrong day? I didn't make a top trade alert. Oh boy. Did I mean to do it and thought I did it? I did this top trade alert on Delta. That was yesterday though. Yeah, I like Delta on that pullback. I'm sorry, I swear that I actually wanted to add something to one of our portfolios and I don't remember where it went. Maybe I never hit enter. Hang on. That's possible. But no, because right before the webinar, I'd say that we're starting the webinar. So it'd be crazy if I missed something. Nope. Huh. All right, it's a mystery. I'll try to figure it out for the members in chat. I somehow in my brain, I was sure that when I was going through the watch list, I said in chat that we should add something. How insane is that? It wasn't the top trade alert, obviously. Could I have added it on Tuesday and not realized it? IMAX. That was yesterday. Here's Delta, which was a top trade. Maybe I was thinking of the IMAX. So yeah, so we added IMAX to the short-term portfolio because I think IMAX is going to totally blast off from the movies. You know, we had that Inside Out, right? That made over $1 billion. Not, you know, obviously not $1 billion in IMAX, but they get their share. That was completely unexpected in a completely dead period of time. That's great bonus money for them. And now we're in a real summer blockbuster season where attendance seems to be way up at the box office. So I like that one. So that's at the bottom of Tuesday's post. And then we also talked about Delta Airlines and how we played that. So I'm very happy with both of those plays. And what else did we do? Oh, and we sold some, we sold short calls on UPS to cover our position. That was a good idea. Thank goodness. All right, guys. So that's where we are for now. And I will, if there's another trade, I'll find it. But that's the one I'm thinking of. I'm pretty sure now it's IMAX. And I somehow thought I did that today, but I did it yesterday. All right. Well, have a great day, everybody. Take care. And we will do this again next week. All right. Have a good weekend.